Hello, Maverick Traders. This is Rob Reinhold. I'm joined by Darren Fisher, and here we are going into the second week of October. Our prediction in August has turned out to be true. We called this prediction because of the 6 weeks starting September 1st to October 15th is the worst period in the stock market historically. The most crashes have happened during this period, and we said, hey, look, just everyone be careful. Look, we do this every year. Some years it's very prudent, and we get the big down move like we're getting this year, and some years it just doesn't happen. But we always talk about, hey, at least knowing about these seasonality patterns. So here we are, we're going into the second week of October, and the markets look lousy here. So let's talk about what happened last week, because we started off the week with a huge rally. So Monday and Tuesday, we had a huge rally, 6% over 2 days. It was enormous. On Wednesday, we actually were down about 1.5–2%, and then we rallied all the way back up to break even. So Monday through Wednesday looked like the buyers were back, everything was great. Thursday was a little bit of a down day, but on Friday, we got the payrolls report, and it all was wiped away. Not all, we were only up about 1.5% for the week. So the big stories are interest rates have started to rise again. We saw interest rates going all the way back up to where they were last week. We also had the US dollar that sold off at the first part of this week, went right back to where it was last week. And then we got the news with oil. On Thursday, we got the news that OPEC was going to cut production by 2 million barrels a day in a period of time where oil is in a short supply around the world. And oil was down to $78. It closed at $92 a barrel on Friday. So here we are on this Friday. We are back to where we were last Friday. If you remember, last Friday, we closed on our lows. The VIX had spiked to 32. Interest rates were up around 4.3% on the 2-year and close to 4% on the 10-year. We had the US dollar making new highs. Everything is right back to there except for one thing. Oil is substantially higher, making it even worse. So last week, we thought we were going to have a big fall. The market had a little rally, but we've been calling that it's nothing more than a bear rally, and it's really starting to look like that. So last week, I want to just talk about a few key points. We discussed that good news was bad news, and bad news is good news. And what we meant was that if the economic reports come out and they're weak, that's actually good news, because that means the Fed will start to cut back on their interest rate rises. And if numbers are very strong, it's negative, because that means that the markets will expect more interest rate hikes. So the rally really started on Monday morning. Monday morning, the ISM came out at 50.9. It was supposed to be 52.5. Wow, what a bad miss. That's exactly what the market wanted. The market rallied. The market rallied on Monday. Then on Tuesday, we got the JOLTS job openings. Supposed to be 11 million, it was only 10 million. The market rallied on that again. So again, bad economic numbers are actually good news here. And then on Wednesday, we actually got some numbers that weren't so weak, and we started to falter a little bit. And then on Friday, we got the non-farm payrolls report, and it was stronger than expected. Not so much on the headline number, 263,000 jobs, but the unemployment rate fell to 3.5%. If you remember, after the Fed meeting, Chairman Powell specifically said, we want to get that number up to 4.5%. That's what they said. They want 4.5% on the unemployment rate. This is going the wrong way. It's going lower now. The market is now thinking, oh my gosh, the Fed's going to have to be even more aggressive than they have been, because now the unemployment rate is going even lower. This is definitely not what the market wanted. And I know it's counterintuitive, but the market wants bad economic news. Now, look, they don't want terrible. They just want a lot less than expectations. Darren, what did you think about the Friday employment report and their market reaction?
It was really interesting. I was just looking. I think that just added gasoline to what began happening on Thursday. More insult to injury than anything else. This I think was you're just looking at it from a technical standpoint. This was a great bear rally that we went up so fast. I think was due to a lot of short covering, and then that dried up on Thursday. That's how I'm reading the tape right here. I'm not looking at this fundamentally. I'm totally looking at this technically. Uh, but yeah, that is a lower expectation. I mean, when you've got the chairman of the Fed saying we need unemployment to rise by at least 1%, he's going out and saying we are going to kill jobs. That's the current state of the environment that they're in. I think we've got a ways to go.
Yeah, there's no question that the worst news, and again, that's when we usually bottom out in bear markets, is when the news gets the worst. I don't think we're there yet either. I don't even think we're close. So let's take a look at the numbers for last week. In the end of the week, the Dow was up 2%, S&P up 1.5%, NASDAQ up 0.2%. Look at that number in oil. As I said, we're basically exactly where we were last Friday. So last Friday, if you take a look, we were closing on our lows. We had just broken down. Everything looked terrible. We got this huge rally, and here we are back down. We're right back down to these levels here. And so it's just looking very, very negative. And we are looking at this and saying, okay, well, what is going to happen in this market here? Technically speaking, and Darren, you said it perfectly, we're looking at this technically speaking, we're going to go lower. That doesn't mean that's what has to happen. That doesn't mean that's what's going to happen. But technically speaking, this is a perfect bear rally, just like we had back in September, just like we had, back in May, whenever we had these little bear rallies, until we finally get to a capitulation move, a capitulation bottom. And I definitely don't think we've hit that capitulation bottom yet. Now, my call is that we are going to see downward movement the first couple days of the week, which is going to take us down to this low right here that we set back at 3580 in the S&P, 3585. That's about 1.5% lower. We have huge news this week on Thursday with the consumer price index. I think we go down to this level the first 3 days. Maybe we even pierce below it and bounce back, but I think on Thursday we are at these lows. And then the news is going to determine what happens after that. If the CPI is less than expected, then I think we can get a fairly sizable rally. Look, maybe all the way back up to the previous high. If the CPI is bad, I think it's over. So again, we either bounce at this level or we tank. But I think we have some runway to go until we get anywhere near some support. The CPI is going to be a big deal. Take a look at the NASDAQ. NASDAQ is in the same boat. It just looks really, really weak. We are back down to where we were. Nothing looks great here. So technically speaking, I don't care if you're bullish. You can write me an essay on all the reasons why you're bullish, all the reasons this. If you look at a chart and you believe in charts, there's only one side to be on, and that is bearish. You have to be bearish these markets. Now, the big question is, where is the bottom? Where is a tradable bottom? And we talk about these tradable bottoms. This was a tradable bottom back in the summer, to where we finally reached this low after just stair-stepping down and down and down and plunging. We finally got a point where we actually had a nice little rally. So until that point, it's likely going to be more downward movement. How do we know when that rally is going to come? Well, we like to look at the VIX. We call these points capitulation lows. It's where people have just thrown in the towel. They say, you know what, that's it. Either they've sold or they've gone out and bought hedges. And this is what we look at the VIX is hedges. And we talked about every time it got to 32 and above, we found bottoms in the market. These were 4 really good bottoms in the market back in May and June. We got up here last week, and it was a good little 6% rally. Look at us here. We're going right back up. I think we got to get up into these ranges, and my call last week was that we even go higher than these last ranges. That the panic gets even more, and we go up into the 35 to 40 area. What do you think the VIX is telling us, Darren?
Exactly what you said. I think this next move has to be more panic inducing for us to be able to clear out anything. Right now, I'm looking at the VIX and I see too much hope, if that makes any sense at all. But there's not enough people that have thrown in the towel. I think I think 34 is the minimum that we need to see before we can say, okay, this is a tradable bottom. This is it.
Yeah, agree. And if we do get that spike, if we do get that spike up into 36, 37, 38, and then we stop going lower, I think it's time to take all your shorts down and to pull them all off and go to at least neutral, because those are when we get these kind of tradable bottoms. Until then, I think you got to stay on the short side. So our prediction is the markets make some new lows. 35.85 was the last stop last week. We've got that VIX above 31. That is just telling you that there's a lot of fear out there, but we need to get to a point where there's more fear than normal. And if we do break below this 35.85, it's the February 2020 highs right before COVID hit. That's our next support level, and that's right down around 3,200. Are getting into the end of this seasonality period. It doesn't mean that it has to end on October 15th. There's nothing in this seasonality thing that says October 14th on Friday is the absolute low. That's not how these things work. Seasonality patterns are like, okay, we look at a bunch of years and we take a look at the averages and we say, hey, the average lasts about 6 weeks during these periods of time. But we have to start thinking about, okay, we are getting out of the seasonality period. As we go into the midterms, when you take a look at seasonality patterns after midterm elections, it's usually quite bullish. If you take a look at the best 6 months return, the 6 months after midterm elections are one of the highest returns for the market. So again, we have to be thinking about this. It doesn't mean it has to happen, but we think about these seasonality patterns and we at least work them into our trading plans. We are going to hear from the banks next week for third quarter earnings. So we have major banks and brokerages, JP Morgan, Wells Fargo. I do think Taiwan Semiconductor is kind of the key though next week. That's on Thursday. We've had a lot of warnings out of the semiconductor industry. They've really led the NASDAQ higher. If they warn, it could really cause a big move down. Next week, we've got other things like retail sales, consumer confidence. Who cares about that? There's only one thing that matters this week is CPI. And the CPI is going to either give us a bounce or it's going to push us to new lows. And that happens on Thursday morning. So I see a little bit of weakness going into Wednesday. Thursday, to me, it's more of a coin toss. They always say on TV too, you can't look at just one number. But as a trader, that's literally what we're looking at is one number because it's going to make a movement in the market for the next week or two. After that, it's not going to matter. It's going to fade away. But for the next 2 weeks, this is the report. Darren, do you think there's any hope at all that the CPI comes out a little light? I mean, we had oil down to 78. Gas has given us some relief. Do you think we got a shot here?
No, I don't think so. I think the CPI number has surprised people over and over again. And you could hear it in the Fed's rhetoric for the past year. First, it was, inflation was going to be momentary, then it was transitory. Now they're playing catch up with this is, endemic right now. So I actually think this number surprises to the upside and forces the Fed's hand to even move even faster.
And if you're right, it means dollar shoots up, interest rates shoot down, and it is very, very bad for equities. So there's no surprise where we lean here. We're technically at a -3. We're below the 20, below the 50. The slope of the 20 and 50 are sloping downward. We are as most bearish as we can possibly get here. Our weekly outlook is -2. Now look, it was a -2 last week, and we had an up week. We could see maybe some of the same, but as everyone has been watching this market knows, this market is way more sick than it is healthy. And we'll get little bounces here or there, and it might frustrate some of your bearish trades for the short term. Bearish has been the direction to be, and it's paid off way more than being long. So let's take a look at some sectors here.
Yeah, the sectors were a little bit interesting. You can see, just look at that histogram right there, where you've got energy up 13.5%. I mean, this is obviously with the move in oil. That's what caused a lot of this. Pulled a lot of the energy sector that was kind of in a malaise, and made it bullish again. Then you see utilities, real estate, consumer all down. Everything else was up. I mean, and that number on utilities really, this has been a sector that has hung in there and hung in there and has performed well for a lot of people. That's no longer the case. This is as you're seeing here in the chart. This is as bearish as I have ever been on utilities, and I never thought I would get to this point. Real estate, you can tell, with interest rates going up, so you can see, taking out energy, we've got six sectors that did decently, at least, a 1.25% gain, the highest, being industrials at 2.8. But you look at these charts, they still are not looking very good. I mean, if you take a look at each sector, if you take a look at the broad markets on a weekly chart, this is the week of the long upper shadow. I mean, we really gave back just about everything, from Monday's open. So this is where this tells me that there is no strong there's no steady money in this at all. This is all fast money, and people are getting much more defensive. And I think they have even further to go. But let's take a look at the individual charts here. Last week on utilities, I was at a -2. I just have a bias for utilities being able to hang in there, but the technicals just didn't support it. And right now, you can see we broke through to new lows, for this year right now. So I got to go -3. Rob, have you ever seen utilities this bearish? Because I can't remember a time when they were.
So here's the irony, and I'm with you, Darren. Like, I rarely ever think of utilities even having the possibility of being +3 or -3 because it's such a low volatility sector. I mean, that's just the nature of utility stocks. They're slugs. They're low and slow, and they just don't do much. This year, we've seen both +3s and -3s, which is definitely a surprise for me for utilities.
So -3 on utilities right there. Com services, I'm still at a -3. And a lot of stuff. I mean, we're hitting down there in the lows. I mean, this thing just has wanted to go down for the entire year, and we've been making a lot of good money on the short side for being short communication services. It continues to be. I think we make a whole entire new leg lower in this sector as well. Real estate, that's looking just as bad. New lows in real estate right here. I mean, we're way past June. I mean, we've gotten June. We couldn't even make it up to the 20-period moving average this week, and then we broke down to absolutely new lows on Friday right there. So this is not looking good. I mean, you can see how far we've come from 50 back in early summer, late spring, early summer, down to 34. I mean, that's a what a 30% move to the downside in that period of time. Just absolutely unbelievable that real estate could go down that far, that fast. One of the ones that's looking better, but by no means good, is industrials right here. This is only a -2. So we went up, classic bear rally, but we're not at new lows right now. And when you're trying to evaluate these things of which is less bad, that's kind of the criteria that you have to adopt. Is you have to pick something. Okay, what is going to differentiate? They all look like dirt, but how can I differentiate which dirt looks better than the best? And this is one of the ones. Utilities is not back to its lows, so this is only going to be a -2. Coming up on healthcare right here, this is another one, -2, same criteria. We're not at the lows. And that tells you the kind of the state of the market where you're looking at it and says, well, we're not at our lows, but we still look awful. So this just looks a little less awful. Same thing for healthcare right there. Financials, much the same story. We're almost to our lows. I mean, I was on the fence about financials. Are you -2 or -3? But this is one of the ones still looking really weak. It looks less bad than some other stuff though. But this is definitely not something I'd want to go long. Consumer, we're only at a -2 right here. We've got a little ways to go. Actually, further than a lot of things to go before we hit those lows again. So, consumer has been holding in there better than a lot of other things. Tech. For tech, we're looking at a -3. I mean, this is so close to we're below those June lows. We're almost. I mean, we're within spitting distance of last Friday's lows right here. There's nothing that looks good about this chart. So I'm at a -3 on there. Materials. Look at materials. We've got some room to move. This is a -2. This didn't give up all its gains that it had for the week. So we're still looking okay right there. And energy. Last week in energy, I was at a -1. And take a look at that movement in energy. 13.5% up. Firmly puts it, I mean, gap up on Monday and just kept going up and up and up. So I'm in a +1 right here. I look at the candle on Friday. It says, is this going to stall out right here? Could quite possibly do that. We're at a little bit of a very minor resistance point right here. But I think in the near and midterm, you have to go back bullish on energy again. So to put everything in perspective here on our outlook, you've got 9 sectors that are either -3 or -2. That's how bad it looks. And one lonely sector up there in energy is the little engine that could coming back into favor again. The worst looking ones you can see: tech, utilities, real estate, communication services. Those are about as bad as a chart could look. Less bad, but still not looking good: materials, consumer, financials, healthcare, and industrials. Let's take a look at some trades here. Last week we were long BEKE, and you can see it's still not looking too bad. It just didn't really go anyplace. We're at the bottom of this trend right now. It's still in an uptrend technically. If you wanted to wait to get on the trade, that's probably pretty good. If you got into the trade, you're probably looking at a small loss right now. This was down 6.6% for the week. But if this is just a momentary bull pullback, then I think you're going to be fine for as much time as this trade has on it. This week, we're looking at Weyerhaeuser, and we're going to go short here. And this is a classic bear rally right here. It rallied up very near the 20-period moving average right there and rolled over Thursday and Friday. So this has been confirmed. This is a good trade to look at getting into next week. This one, we're just going to go out to October 21st, and that 27.29 bear call spread is what's going to be looking pretty good right there. So you're going to be short that 27, long that 29. This is going to be fairly delta dependent here. You're going to have a little bit of theta in there. This is something that definitely needs to move down to be a good trade. But Weyerhaeuser is really looking weak right here. So communication services. Last week we were short Snapchat. And this rally, I mean, this is one of those, rip your face off rallies in this thing, but it also confirmed to the downside. So if you got in the trade last week and you were short, you're looking at a little bit of a loss. It gained 8.5%. But you take a look at Friday's candle. If you haven't gotten into the trade yet, Friday was your confirmation right there. This bear rally is over, and it's probably headed back down to 10 at the very minimum right there. So this week we're looking at Roku. And you can see it's a really weak chart on Roku right there. We broke through descending triangle, short-term low base right there. Broke through that on Friday. So what's the best way to play this one? This one, you can go out and play it a little shorter term at 54.56 for October 14th. Give that trade 1 week to work. Or if you want to go out a little bit longer, you could go all the way down to 50 and short that 50, go long that 55, and give it a couple more weeks to work. Either one of those trades is looking pretty good. It just depends on your time price. So last week in healthcare, we were long AGL. And this one really held in there, fairly nicely. As much movement as everything else had. This one was down, 3.67%. So you could say if you got time on the trade, let it run. If you want to, if you haven't gotten into the trade and didn't trigger for you or whatever like that, you could adjust the strikes. And this is something I'm looking at after this week's action. And I play this more sideways than I would long right now. But this is still, I think, a pretty viable trade, given I mean, we've been going out with long time horizons on these trades. So I think you could go out there. Right now, we're looking at a high base breakout for Dexcom, DXCM. And you can see, I mean, just nice gap up on news. Went from 95 up to close to 102, 7.2% move in 1 day. I mean, that's pretty good. So some news must have come out on here, but this looks really good. I'd be going out to those November 100s, go long those November 100s, and short the October 21st 105s. Nice diagonal call spread right there. You want to wait for confirmation to make sure that this is not an island top. Please do so. I don't think there's anything wrong. This thing's probably going to take a little bit of time to consolidate that move. But as long as it doesn't break below, the lower shadow that we had on Friday, I think you're looking pretty good right there.
In the industrial sector, last week we were looking to be short UPS and it came through. UPS did have a nice little rally, but by the end of the week it had closed lower. And love this, it's already broken down below its low. I've got one more week on this trade and it's setting up very, very nicely to head even lower. This week in the industrial sector, looking at 3M. So we've had this little break here, at this little low base from breaking below the support. We chopped around here. As you can see here, nice big candle here. This one's looking just really, really terrible, which we love here at Maverick when things look terrible. So the big question is, how do you play it? Now, I want everyone to recognize, and I talked about this last week, we're doing only spreads here. The reason we're only doing spreads, we are not doing long calls, long puts, because right now those are puffed up with lots of premium volatility. Now, yes, the market is way more volatile than it normally is, but it really hurts you when you're paying all this premium for this volatility. By using a spread, you're basically eliminating that volatility because you're long one and you're short the other. So the volatility cancels each other out. So this one's a pretty simple trade. It's a 105, 110. It's basically splitting the stock right in half. This will have no effect of volatility. Volatility will be completely canceled out on this, and this will only be a delta play. It's only a delta play. You've got 250 of risk, you got 250 of reward. That's the play. It's a very, very simple trade because when you add in all these other components in your options trading in high volatility, you can be right, but volatility can shrink or volatility can grow and make your trade unprofitable. By using these kind of spreads, you're just making it very simple. You're taking all of that out of the equation and just focusing on the underlying movement of this chart. In financials last week, we had a short on Upstart. Now, Upstart's been one of the weakest stocks out there, and you can see it is still low basing. So we've got more time on this, and I expect this thing to break one of these weeks. And when it does, we'll have a nice trade on our hands. As you can see, this thing is on the march of death. Stocks like these typically just keep going until they get into the single digits, especially in markets like this. This week, we're going to take a look at Aflac. Now, Aflac is actually a fairly decent performer in the sector. We always need to have some sideways stuff, always need to have some bullish stuff, even when you're at a -3. We still want to have some exposure to the bull side, so we actually have a nice rounded portfolio, and we want to have these stacked with different time frames, with different strategies. So Aflac has been holding in fairly well. Now, overall, it is making its way a little bit lower. You can see here, we had the descending triangle. We made a low down here to 56. So the question is, okay, well, how do you play something that isn't like Upstart that we just looked at that looks like it's going to fall out of bed and just crash? How do we play something that just looks moderately weak? Well, this is where a targeted butterfly is fantastic. And we've been using a lot of these lately. So really looking at just a 56. So looking at a 56 on the target and looking to just go out and be long the 53 and the 59. So basically what we're saying is we think it's going to stay in this area and we think it's going to stay closer to 56. So giving it 2 weeks out, the October 21st expiration, this is what we're looking for on Aflac. So bearish, but just slightly bearish, more of a neutral to sideways play here.
So last week in consumer, we were short Wayfair, and you can see it did very nicely for us. It really had that nice breakdown. Broke through the lows on Friday, and this thing was down for the week about 5.9%. You can see, look at just Friday's move right there, down almost 9% on Friday. So once you get a breakdown like this, they move fairly quickly. Just look at the volume, the velocity, the size of the move. I think this one's got a lot more to go down. So we're going to hold on to this Wayfair probably until expiration and just see where it ends up. This trade's looking pretty good for us right now. This week, we're looking at ADM, Archer Daniels Midland, and we're looking at that sideways. You can see, this is one that did make some gains and held them. Thursday and Friday looked really good for ADM right here. But we're bound between the 80 and 90, and we're sitting right pegged at 85 here. So what's the play that we're going to do on something like this? If you think you're just going to go sideways, then that's what you want to play. It's clearly bounded right there. So 80, 85, 90. give it 2 weeks to go. And I mean, your profit area on this is probably going to be somewhere between 82.50 and 87.50. So if it closes in the next 2 weeks, anywhere in there, I think that's probably where your profit range is going to be. So you let this thing bounce around like a marble. That's fine. And if it ends up close to 85, there's your max gain right there. Now, technology. Last week we were long for solar, and you can see if the trade triggered for you, you were in a diagonal, and so that looked pretty. That was looking pretty good right there. It was down 2% for the week, but with what you sold in that premium on that diagonal, you're looking pretty good. This is just right now back into we pierced that high base right there. Now we're just at the lower end of the high base. And considering how much the market moved to see First Solar holding up like this, I'm quite happy to be long this still. We're looking right now on the other side of the tech world is DocuSign. Low base right here, broke through, confirmed on Friday. You can see 7.25% move in 1 day. I mean, a lot of these things are moving fast. You have that breakdown. Nobody wants to be there. Nobody wants to leave my house, forget my number, don't call me. That's where a lot of people are saying to DocuSign right now. So back to that spread game, just that 45-50 bear call spread. Again, about 215 risk, 215 reward. You can see it sitting right there at 47.83. Give it a couple of weeks to work, but this thing is definitely going lower.
Last week in materials, we had Vale, which is a mining company. We had it on the long side, and it did very nicely, up 8.2%. And we actually had a bullish targeted butterfly on this one. We actually had the 14 was the target on this one. And the close on Friday is very good. This trade is already pretty profitable. It's got 1 week left. So if we just drift down a little bit more into 14, that's going to be absolutely perfect for these targeted butterflies. These targeted butterflies are also really nice trades to make in these times of volatility because you're taking a lot of the volatility out. And you're basically saying, hey, I think this thing's going to move. And then once it moves into your profit window, take at least half the trade down, if not all of it, and just move on to the next one. Very nice trades here. This week, Alcoa. We're looking at a bear rally here on Alcoa. So Alcoa, we set new lows last week. We had a nice little rally, could not, for the life of itself, break through that upper resistance level, and we got the confirmation candle on Friday. So the big question is, okay, it's at 38.50. How do we play this? Well, you know what? Let's just go with a very simple bear call spread. The target here is 36. So we are not asking for this thing to even go down to its previous low. If you want to get real aggressive, maybe you go down to 34. But I'm just looking for a single here. You know what? I'm going to go with the 36.39. If it closes below this area, then you know what? That's going to be a nice trade, max gain for this. And then in the energy sector, last week we had a sideways trade on CRK, Comstock Resources. 1750 was the target point. And you can see another great little targeted butterfly at some point. It would look like, it might be getting away from us. It comes right back down into our profit area. The trade is already profitable here. If you want to take off half, take off half. This is just a really nice way to trade in these markets. You can be as crazy as you want in these crazy markets, or you can be as boring as you want. That's a great thing about options trading is you get to decide how much am I willing to risk? What kind of trades do I want to do? Do I want to do more sideways? Do I want to do more directional? And a lot of times these trades are easier trades to make in these high volatility times because they don't put pressure on you. Like this trade never puts you under any duress to where you have to make a decision of whether to stay or to bail. It's just a very easy, slow moving position. So we're going to go ahead and just keep doing that same thing. Here is Occidental Petroleum, and it's had a nice run, but ultimately 60 down here, 74, 75 up here. We're in a range. We got moving averages just flip-flopping on top of each other. So the question is, okay, where do we pick the middle? Where do we pick this middle? And we can be slightly bullish, we could be slightly bearish, or we could be just right on it. Now, I'm with you, Darren. I think the energy sector is likely to hold in or at least move a little higher. So for me, I like where it is right now. So again, the 70 is the middle, and then go down to like the 65 and the 75. So basically you're saying, okay, I think it's going to be in this range here for the next 2 weeks. That's a good looking trade here. It can go up a little bit and then turn back down. You're going to be in a great situation. So that's a sideways trade again in the energy sector on OXY. If you're a Maverick trader, please jump onto our Maverick Trading website, log in, and let's get the forum going. We love it when our traders are always working together, helping the whole community make more money. So please share your trades with everyone. To wrap this up, I think the retest of the recent lows is likely. I think that CPI, I think that it will be the determining factor of, do we see new lows for the year, or was that possibly the low for the year? I know that's very dramatic to say with 2 months left. So many things can change. And that's why as traders, we never, ever marry any sort of idea that we have, because we understand that all the data can change tomorrow. And if we're holding on to an outlook because we think we're right or we're embarrassed to look wrong, you're going to take losses in trading. You need to simply be able to let things go. I can come out with a bold prediction. Tomorrow, new data comes out. I'm wrong. I'm flat out wrong. Okay, great. Let me dump that and let me just go on to a new premise until I figure out what's right. That's how you got to be as a trader. So I think that CPI is important. I think we get one more plunge lower. I think we get that VIX spike up close to 40. And I think that is potentially the low for the year. What do you think, Darren?
You're actually more bullish than I am. I think we're going to go even lower. I think we're going to take out those February 2020 highs in very short order. And I think we've got another at least 10% down left in this market, probably closer to 15.
Well, geez. I was trying to end this on a happy note. Look, you are definitely...
You're on the short side. That
look, I'm short.
You want to be right there.
Here's the funny thing is that I'm with you. I think that's what's likely to happen. I think what your premise is much more likely to happen than my premise. So we'll see. That's a great thing about trading. As I said, new data comes out next week, and we'll change our minds about it all the time. We just want to be with the market. And let me just share one story before we let you go here. One of my favorite stories to tell people is I've got a good friend, Joe. I've been trading with him for over 20 years. And I remember early on, I told him, Joe, I know I'm right. I know I'm right on this trade. And he says, I don't care if I'm right. I just want to make money. And I realized, oh my gosh, I'm more concerned about being intellectually correct. Joe doesn't care. Joe has no ego. He just wants to make money. He just wants to be on the right side. He doesn't care what side it is. He doesn't care what stock it is. He doesn't care. He just wants to make money. And I realized he's got it. He's actually got it more than I do. So that's what we want to do here at Maverick. We just want to be on the right side. Right now, the right side is bearish. And we're going to stay there until the data changes and shows us that we're wrong. Everyone have a great weekend. Stay safe out there. Goodbye, everybody.
Good trading, everyone.